The head of the Federal Reserve, Janet Yellen, has been on the speech circuit and also talking to Congress, and she's providing actually surprising clarity in terms of what the Fed is going to do. It now seems almost certain, never quite certain, but almost, that the Federal Reserve will abandon its zero-rate policies and increase the federal funds rate for the first time in a decade on December 16th at the next meeting of the Federal Open Market Committee, FOMC. What's becoming more interesting is what the Fed is going to do after that. And what Janet Yellen made fairly clear is that the Fed will remain data dependent, but the most important data is no longer going to be the employment data, it's going to be the inflation data. The Fed's target is 2% inflation, and the Fed likes to look at a measure of inflation that comes from consumer expenditure. So this is not your headline consumer price index, but it's not that far away. Right now, the general inflation rate as the Fed looks at it is 0.2%. The core inflation rate based on this expenditure measure is 1.3%. And so this is well below the 2% target of the Fed. What Janet Yellen is telling us is that any further moves by the Fed will follow the track of these inflation measures. If they don't go up, the Fed's not moving. So we're all going to be watching these numbers, and it'll be interesting to see whether or not the inflation data, which is typically a middle-of-the-month data release, starts to bring a lot more of attention and market activity than the employment data. The employment data is the big one now, and it's the first Friday of every month. So we'll watch this competition between these two data releases. The other thing we're going to be watching is the long-term bond yields. Inflation is really the most important determinant of long-term bond yields, not Fed policy. And so bond yields aren't going to rise either unless we see a rise in inflation. And just for the record, we do expect inflation to be rising very incrementally starting from around March, April of next year. And that's not because we're really seeing that much more inflation. It's simply because the impact of the declining oil and gasoline prices in the first quarter of 2015 will drop out of the year-over-year comparison. So on net, very slow pace of Fed movement, probably only a 1% Fed funds rate by December 2016, and a flattening yield curve, not a bond sell-off.